And we did a real estate transaction. It was terrible, not on his part or his buyers, but my son. She was terrible. I'll never forget her. He's a veteran. He held a top secret clearance. Navy veteran. Don't hold that against him.
Squid.
And him and his partners, he's teamed up with several sophisticated investors that are extremely smart. They hold over 2,000 units currently, and they're going to acquire another 1,000 units in the next 12 months. So I'll leave that to Dino to kind of explain how they're doing it and how you can get started and be a part of it.
Thank you. It's awesome to be here. I'm super excited. And yeah, I think we've done Brent, I think we've done maybe two
two deals.
We've done a couple deals
The
together.
second one wasn't as bad.
No, that one was less, fortunately it was less memorable.
I don't remember it. I just remember we made a little bit of money.
Yeah. But thank you so much for having me. I'm super excited to drop some gold nuggets on you tonight. I'm very open to write down questions. We can do it as we go along. We can take questions at the end, whatever's best for you. I'm here for you guys to help educate. I always like to tell people I have nothing to sell. Like you couldn't even say, hey man, can I buy something from you? Sorry, I can sell you a mint or something from my bag. But don't worry, tonight is just all about me giving to you and spreading some education. Like you said, more about what I've done, our path, and then dropping knowledge on all the benefits associated with being a passive equity owner in an apartment syndication. That's what I'll be focusing on this evening. All right, so who am I? He's already, some of this, I'm just gonna hold this, some of this he's already said. I have been investing in real estate since 2014. So when I started out, probably like some of you in the room, I started out wholesaling. I was scouring Craigslist. I was doing direct to seller marketing, focusing on building up a massive buyers list. I did that, and then I started realizing, well, you're selling the cow, and that doesn't always make sense. So I started partnering with people who had the knowledge and wisdom, and they were able to run a crew and do fix and flips. And then I started lending what I call supplemental private money loans. So not more than $20,000 or $25,000 out at one time. I would partner with the person who was, like I said, running the crew, running the project, and then we would do some type of profit split. And in addition to that, I would make a little bit of interest on the money. So a little bit of all that, and then eventually I got into syndicating apartment buildings. And I'm going to talk about this in more detail tonight, but it took a while. One of my friends had kept telling me, he's like, the wholesaling and the fix and flip and the lending, it's a job. You have another job. And look, nothing against it. I'm not here to talk down on that. I'm just talking about my path. And he was right. And it took him a while, but finally he got through this thick skull, and I said, hey, maybe I should look into apartment syndication. So I got educated. Partnered up with some really good, like he said, knowledgeable, sophisticated, experienced investors, and that's why I'm here today, sharing my story and sharing this information with you. I already mentioned this about the number. I was raised by, and I know I hear this is rare, but I was actually raised by bootstrap entrepreneurs. My grandfather, no one worked for anyone else. My parents owned their own business. My grandfather owned his own business. It's an incredible story if you ever have time and want to hear it. But so I just had an entrepreneurial mindset from the time I was born. It's all I saw and all I knew. And I love business and I love being an entrepreneur. On top of that, I already talked about the supplemental money loan, but for the past 7 years, because I do love business, I manage all the business for a medical device company as well. So I have 2 full-time jobs, and I really love that because it's just an extension of business and going in and having tough conversations and talking about benefits, like exactly what I'm going to be doing tonight. But our company, the company that I work with, we were just last year by Forbes called one of the most innovative growth companies. So I always like throwing that in there. Like you said, I am a veteran. I was an intelligence specialist from 94 to 98. I was in the Persian Gulf during Operation Southern Watch. I am a squid, and I was on an aircraft carrier called USS John C. Stennis. I already kind of mentioned this. My partners are phenomenal, and I think a lot of people say, how'd you get into investing? Like he was saying, 4 years. Look what he's done. I just always try not to be the smartest person in the room, and I'm probably not the smartest person in the room tonight, even though I have the microphone in my hand. And I just found really good partners, and I asked them, what can I do to bring value to you? Even if it means working for nothing to get your foot in the door, that's an excellent way to show someone that you're worthy, that you bring value to the team, and start a partnership that could go on for a very long time. All right, continued. So we'll talk about this real quick. I created this company called Edified Equity, and that's my investor relations company. So you kind of look at the background, Edify, to instruct, inform, benefit, to enlighten. So basically, I'm taking the equity, which is the ownership or the profit, and we're edifying it, we're educating, and that's why I chose the owl as a logo. And I like these, kind of cute, and he kind of has the same glasses like me. All right, so who are we? Real quick, and then we'll get into the presentation. So I'm part of an investment firm or an investment group, and we specialize in syndicating large multifamily apartment complexes across the United States. We have a special focus in raising equity from private investors, so that, and that's why that's the topic tonight, so that you can have your money go to work for you. And there's unique things that I'm going to cover that make it different than just me coming to you and say, hey, can I borrow $100,000? Because that's not how it goes. Collectively, he's already said this. So we do control right now across the United States over 2,000. We are on track to add another 1,000 units to our portfolio this year. Okay, so why? I always like to start talking about this. Why apartments? Why did you stay in the wholesaling and the lending, partnering with flippers? And you notice he never said, and I don't. I've never had a single family rental. Not that there's several ways to create wealth, okay? And I'm just talking about one of those. And again, I'm not saying anything bad about any method, but let me tell you why apartments. So consistent returns that will outperform mutual funds, bonds, 401k, IRA plans, and the stock market. And I'm speaking from experience. And if we have time, depending on how it goes, I'll tell you my stock market story. But I'll just tell you, long story short, I would have been better off burying my $100,000 in the backyard. It would have been safer, and I could have battled inflation better than the return and my experience in the stock market. We also have a huge demand for affordable housing in the United States, and that is not going away. A lot of people are nervous or concerned about the crash, it's going to crash and all that. So I believe personally that happened because banks weren't doing the right thing. You know, you've all heard, if you can fog a mirror, you can get a loan. That's not happening today. So we're in a different time. And yes, we're rising, and the market's crazy and hot out here. It's hot in Denver, hot across certain areas of the country. But if that did happen again, and I'm not saying it will, but if that did happen again, people who are living in an A-class apartment, those are the people who are paying more rent than your mortgage. And the people who, unfortunately, I just had this conversation earlier with someone attending, people who are living in homes that are going to end up, going upside down and they're going to lose out, they are going to come to affordable housing. They're going to look for B and C class apartment complexes as a place to live. So it's virtually recession proof. Now, multifamily has a way of riding out recessions. It has a way to not only sustain it, but continue to cash flow and appreciate. And it has outperformed the stock market for almost 2 decades. Unique tax advantage. I'll get into more detail later, but it allows you to legally keep more of the money you make. I even have some of my partners tell me, when you can not pay any taxes, you're doing it right. And this is a vehicle, like I said, that allows you to do that legally. So I always like to start with why. It's not just about, I know we're speaking at the Bigger Pockets tonight, but it's not just about creating a solid return on your investment. Of course, that's paramount, or you'll never get people to partner with you. But what I like about what we do in the B and C class space is we do something called impact investing. So it's multifamily with a purpose. And it's in alignment with my why and why I like this type of investing. But basically, it's investments made into companies and organizations and funds with the intention to generate, this is the cool part, measurable, beneficial, social, or environmental impact alongside the financial return. So I want people who live in our apartments to feel safe. I want them to feel proud that that's their home. They like the amenities. They like their neighbors. They like the management. And it also does something for the area when we can turn an apartment building around and really make it shine and be a nice place. So deal or no deal. Everyone asks me, well, what do you look for, especially brokers? They'll say, what are you looking for in a deal? Or people who are good at finding off-market apartment complexes. So I'll go through our criteria. So we focus on cash flowing. And I'll say this a couple times, but we don't look for any type of major repositions. Now, don't get me wrong. If a vacant building came along and it was in a nice BC area, we can get it for, I don't know, $5,000 a door. We could bridge into that. But normally, we're not looking for that type of opportunity. We're looking for something that's cash flowing from day one, light to moderate value add component, and I'll get into detail about what that is later. Already talked about what class, and the purchase price is 1.3 up to 30 million. Recently I've been having conversations with some partners and realized that maybe we can even scale up, but for now I'll leave it at that. And the reason we do 1.3 is because we're looking for agency financing, and usually we need the amount that they're going to lend us to be a little bit over $1 million. So we do the 1.3 because if they can lend $1 million and we come in with the 30%, this would qualify for the type of loan that we're looking for. Target markets, if you want to put a blanket over it, I mean, I can name certain cities, but just to blanket it, it's going to be the South and the Midwest. That's where we're looking for. I'd like to get into Vegas, but Vegas has kind of caught on pretty quick, and the cap rates have compressed, and it's kind of a barrier for entry. 50 or more units, and I always say this, the more the merrier, and it's kind of another reason why I skipped the single family. Again, there's multiple ways to create wealth, just talking about what we're looking for here. Cash flowing from day one, value add, and in addition to that, we're going to look for some type of upside play. And there'll be a slide later on that I'm going to go into detail about what those are. This is a great opportunity, and it's related to upside, but we want to look for an opportunity that has below market rent. So maybe it's a mom and pop owner. They've been having this asset for 20 or 30 years. They're friends with all the tenants, and they just never really raise the rents to market. That's a simple operation, management skill, or I want to say a value add component that we can implement. If it needs renovations, that's fine, just no major reposition, and an undesirable vacancy rate. Because again, it's a simple fix. It just means management has taken their eye off of the ball, and we need to get the right management team in there. So these are things that we look for. Location. So we want places that are in the path of progress. We want money coming in. We want people to be living there. And so you might be thinking, well, that sounds like Colorado Springs. That sounds like Denver. We'll talk more about that later. But the MSA of 250,000 or more. So we want people coming. We also want people already there. And it gives us the opportunity to purchase that undervalued asset and allow us to create significant value within 1 to 3 years. So we're going to come in, and we might have a 5 or a 10-year business plan, but so that we can give the investors the return that they're looking for, we want to make this happen quick. We want to, strike and execute with surgical-like precision. Oh, I'm sorry, I didn't see you.
What does MSA stand for?
So that's the Metropolitan Service Area. So it's kind of like the population, but it might include submarkets. So if I said the MSA of Denver, it might include Littleton, Aurora, Centennial, might include all of that and be several million. So again, continuing, cap rate. So we do look at cap rate, and a lot of people, I tend to look at things, I'm optimistic, and I try to look at things the right way. So our going in cap rate is going to be anywhere from 6 to 8 or more, okay? Some people say, well, a six cap doesn't get me excited. Well, I even go on to say, we can even go lower than a 6 if there's enough value add component and enough upside in the deal. So I'm less worried about what the current owner's doing, and I'm more concerned about what I know we can do with the property. But in general, 6 is towards the low end, and then we're going to see what we can do when we underwrite and use our projection. We want to see, of course, what we can do with it. After stabilization, we are looking for a solid cash-on-cash return for our equity partners. That is the main goal. If the deal doesn't pencil out, the investors always come first. If it doesn't pencil out to where we can give investors the return that they're looking for, it's not a deal, okay? And I said this earlier, but we do want our deals, we want them, you know, what some people just say, we want it bankable. We want an agency like HUD, Freddie, or Fannie to come in and look at our underwriting, look at the financials that we use to underwrite the deal, and they come back and say, you know what, guys, we like your track record, you qualify for the loan, we like the asset, we understand, and we believe in you, and we'll give you the money. All right, leveraging an experienced team and other members. I'm going to talk about 2 key members that you want to have if you're considering ever being an equity partner in a multifamily syndication. So the first one, and people might not think about it like this because you may or may not ever even know them, but it's your partners. So if we syndicate, and all syndication means is where we have several people, at least more than one, come in together, pool funds to invest into the apartment complex, let us operate it, and you get a return, okay? That's basically all that means. But your partners, so if we syndicated and I needed to raise $3 million and that was gonna come from 10 people, they're all partners. You're leveraging them because you wouldn't need the other 9 people if you can do it all yourself. So they're very key. And if you didn't have those other 9 people interested in this, then you would maybe be stuck in a smaller multifamily or maybe even single family. And then a team of trusted operators. So I'm going to go in detail about what I mean by that, but you want to make sure they have a track record and that they can prove what they say they're going to do for you as an equity owner. What they're going to offer you, a true team of experienced operators, is a turnkey opportunity to own a piece of a business. In this case, it's a multifamily apartment complex. Here's some of the things they're going to do for you. That's why it's turnkey, but here's what they're doing. They're finding the opportunity. They're doing all the paperwork associated with the contracts, the letter of intention. They're vetting contractors, finding property management companies. Property manager, if you want to use a sports analogy, the property manager is the quarterback of the team. And the operating team is more like the coach, okay? But property management is so vital. It can actually, I've said this several times, property management can make or break a deal. That's how important it is to get the right management team in place. So they're going to do that for you. They're going to network with commercial brokers. If you're wholesaling, I know when I was doing wholesaling, a lot of times we tried to avoid brokers because we thought they just kind of get in the way. That is totally not the case. When you switch to multifamily, the commercial broker is your best friend. They are keeping track of, okay, hey, Dino and his team, they bought this 5 years ago. They probably got a lot of equity. Let me call on them, see if they want to sell. They're keeping track of that. They're going out and they're networking with the sellers for you. They're bringing the deal. I say all the time, I try to look at things the right way. It doesn't matter to me if a commercial broker gets compensated 6 figures, multiple 6 figures, for bringing us a deal if it penciled out. If the deal made sense for the investors and the deal made sense for us, it's none of my business what he or she makes. And I shouldn't be concerned with that. So that's a key component. and we're out networking with them, relentlessly contacting sellers. So we might do some direct to seller as well. In addition to that, underwriting deals. This is like a needle in a haystack. I mean, if I had to put a number on it, it's over 100 that we analyze, and it takes time and energy to get these sent to you and to properly underwrite them. You know, look at the trailing 12, look at the trailing 24. What was the current operations doing, and actually find a good deal. They're researching markets. They're building relationships and trust with your equity partners. Those equity partners, number one, you don't even have to know them. They're doing all of that for you as well. So these are two of the key team members that you want to have. And what this does is allows you to truly be a passive owner. Because you can say, I like you guys. I like the business plan. I read through the packet. I looked at some past successes. I just love it. Here's my investment. And you know what? Quarterly, you're going to get mailbox money. You're going to get unique tax benefits I'll talk more about in a second. And you're also going to share in the profit when they refinance and or sell the property. So you can focus on what you want to do. You want to travel, you want to give back, you want to continue working and making more money so you can put more money in. Whatever it is that you want to do, it allows you to focus and continue to do that. So why agency? A multifamily is actually easier to get financing for than it is a single family home. Super easy. They love it. And I got something, I think it's kind of amusing. But apartments are relatively said that already. Banks like the security of a multifamily business, of a multifamily asset. They see it. They're like, sure, you guys, okay, you have the track record, you qualify for the loan, you've got the balance sheet, everything lined up, we like it, we're in. They're willing to do that. They're willing to lend millions of dollars for multifamily. But if I walked into Bank of America tomorrow and said, hey, I love Bank of America. Can I borrow $1 million to buy your stock? They're going to say, no. They won't even lend me money to invest into their own company. But they'll lend for multifamily. So that kind of, I think it's a funny analogy, but it's very true. And I kind of just, I went ahead and did that. Multiple doors under one roof. They see this. It's much less risky than 100 doors under one roof, right? Because if I have one door filled and my tenant moves out overnight, guess what? I'm 100% vacant. The day before I was 100% occupied. If one person moves out of 100 units, or 5 or 10, it's really not going to impact the returns or the investment in a significant manner. So it strengthens, and that's why I say the more the merrier. The more the merrier. Main difference between, so I'm going to talk about this active versus passive. So you see this guy here, he's doing everything, and I went through that slide, and this person over here sitting back and just letting the mailbox money come in. But they both get the benefits, so don't get me wrong. There's a lot of reward being on the active side as well, giving people an opportunity, and like I talked about the impact investing. So we all get to improve the community. We get to provide safe and affordable housing, okay, and offering safe, consistent returns for the investors. However, the active investor gets to do all the work. Pretty cool for the passive investor. So let's take a look. They're going to do all the work. They carry all the liability as well. Because even when we say, like, we look for loans that are over $1 million, we call those non-recourse loans. But non-recourse loans really are recourse. If we don't manage the business, we can't pay that note, they're coming after someone. And it's not the equity partners, it's the general partnership team, it's a team of operators. So they run all the business, and most importantly, they are a steward of the equity owner's money. That's super important to me, and I know it is. It's the utmost important thing to the team that I'm associated with as well. All right, debt versus equity. So why don't we just come out and say, why do we syndicate? Why do we actually give the equity people a piece of the deal? Because that's essentially what's happening. So what debt is, and you all know what debt is. It's when I borrow money at an agreed upon amount of return. So I might say, hey, I want to borrow $1 million at 5% interest. And that's great. You would get a 5% return on your $1 million, and you might be happy with that. But the problem is there's no equity involved, and you can't tap into the unique tax benefits, and you're not getting any of the profit share. So with equity, it's exactly what I just explained. You're still going to get a perceived rate of return, just like if I just said, can I borrow $100,000? But you're also, because you're going to come into the syndication with an LLC that's going to invest into the main LLC, and all the benefits are going to flow through that LLC directly to you, related to the percent of the building that you own. So if you own 10% of the building, you'll get 10% of the cash flow, 10% of all the unique tax benefits, 10% of the profit when they refinance and or sell the building. And they might do both. They might refinance, make a profit. 5 years later, they sell it, you're going to make another profit. Pretty cool. That's the main difference. And I had on that slide there, so you can have your cake if you need to. 3 ways it pays even while you are asleep. So we all know, let me just back up here. Cash flow. So unless it calls for a major reposition, and again, it's not really our niche. We're trying to buy things that are already cash flowing, or just looking for an additional opportunity. You're going to be cash flowing on day one, getting steady cash flow. So right when you start, you're going to start getting steady cash flow from day one. That's one way it pays you. Way number 2 is appreciation. So if we can increase, the way these buildings are valued is different than a single family. If I want to sell my house, an appraiser comes out, they inspect it, and they look at the sold comps. It's not like that. These things are valued off of the amount of cash that they throw off. So if we can increase the net operating income through 2 factors, value add or upside, that increases the value of my building. Okay, I already said that. Value add. So let's talk about those 2 ways. How can I force some appreciation? Well, I can add value to my existing building. But you only want to add value when it brings back a return. You don't want to add value where it's just going to cost me money. I don't know, if they don't have a paved parking lot and we say, hey, we're going to pave the parking lot, but we can't increase the rent or charge for parking spaces, it's not maybe the best business decision, especially if they were fine parking in the grass or the dirt or inside the road or wherever it was. So value add, it's a physical aspect which could be improved or altered, resulting in an increase of income. Here's a few things. So maybe they have a parking lot, but it's not covered, and we can create these metal awnings. Maybe if we have 100 parking spaces and 20 of them have metal awnings now, they want to park in the shade. Let's say apartments in Arizona. Hey, I'd pay $20 a month to have that. It's hot. That could be value add, because those wouldn't be expensive to put up. You can convert 1 bed, 1 baths into 2 bed, 1 baths. Charge more rent for the extra bed. Security cameras. People would be willing to pay. You can bump rents for that. That's an amenity. You can build a pool. Those things, while they are a headache, they can attract tenants. And you can add washer and dryers in the units. These are a few few ways that you can force appreciation or add value. Yes, sir.
How do lights help? Like LED lights outdoors, like light up things. Not like crazy lights that shine in windows, but like nice lights that kind of light up.
Yeah, so he was saying, do lights help? Lights, I mean, I don't know if that's something that we can say is a value add, like they would pay more because it's lit up, but it does help them feel more safe, especially in the evenings.
What is a security guard, like that rides around on the golf cart?
Yep, a security guard could be something that you can hire. That's just hiring a person. And if that makes me feel safe unloading groceries at night, that could be something that I would consider versus the apartment across the street that doesn't have that. It might make me want to, live there.
Gated communities also.
Gated community, that's another way. Yes.
How much value would you say there is adding a washer and dryer to a unit that doesn't have one?
Well, versus, I think, I know people like it because they can do it at home. They don't have to go out to even, if you have laundry facility there, which is another amenity that's good, or if you don't even have that on site, I would say it definitely increases the rent. But what we would do is look at the market. So maybe look at a 5-mile radius and say, who has this and how much more rent are they getting? Similar, space for the unit, 2-1, 1-1, whatever it is, but they have the washer and dryer units. Are they getting, I don't know, $25 more a month, and is that worth that investment? So we would just put the pencil to it and, and see if it made sense. But I think that is a big one. That's a big one. It's an amenity that allows people to stay home and watch. They don't have to worry about what's happening with my kids while I'm running to check the laundry, that kind of thing.
It's about $50 a month.
$50. There you go. So he's a commercial broker. He said that could bump you by $50 a month.
That pays for a washer and dryer quick.
Yeah, the washer and dryer, and then having the hookups. I mean, it's a very common value add that people try to employ. Okay, and then upside is different. So upside is even sweeter because upside really doesn't. It's not going to cost you more money. It's something that you can do operationally. Okay, so like property management. I said earlier, maybe they took their eye off the ball. You can come in and get a property manager who owns a property management company because they're also an investor and they weren't happy with the options that they had in town. That's a good person to interview and vet as a manager. So you're not making any significant changes. Paid parking, so maybe I already have the parking lot, maybe I already have the awnings, but we're not charging. If the market is allowing for paid parking, hey, we can do paid parking. Let's look at some other things. Rents. Like I said, we bought it from a mom and pop. They've owned it for 20, 30 years. They're best friends with all their tenants. That's an opportunity. And I'm not saying come in and bump it up, on natural turnover when the leases expire and bump it up so much that people leave. You can even keep it slightly below market so you can have a higher occupancy rate, but that's a simple upside right there. And then you can charge for amenities like parking, as long as the market has that demand and the market is going to support it. And then finally, amortization. Not only do the tenants pay enough to have the business cash flow and make a profit, they're paying enough to pay down the mortgage. And if the mortgage is lower when you refinance or sell, it's more profit that's going to go back in everyone's pocket. Just said that there. What you must know. So these are some key things. What you must know if you're ever considering doing this, you've got to know the market opportunity at hand. Some of the things like, are people coming here? Or is this a place that's kind of dissolving? So you want to learn everything. Usually they'll put out a nice detailed deal package, and you can sit down and I just go through it with a fine-tooth comb and learn about the opportunity, and then you do some further research on your own. The operating team's track record. Do you feel comfortable with this team's ability to win for you? If you don't, if you have that gut feeling something's just not right here, I would say it's better to be safe than sorry, and don't move forward investing into that opportunity until you can get all your questions answered and you can feel good about it. Why will the opportunity be a success? Have them tell you, hey, okay, I'm looking at this and you're telling me we're going to buy it and we're going to have it 95% full by the first year. Well, why is it 80% full right now? Like, how do you know that we can do that? Ask for stories, ask for some narrative, and question your operators, get your answers. The worst, can it weather a storm? Now, multifamily, if you have the right team in there, I'm telling you, it can weather storms. It can weather another crash. People are going to come looking for a place to live, okay? But you want to make sure that there's enough people there, the economy's strong enough, and that it's going to be able to weather any storm that comes its way. The management team should, when we underwrite opportunities, we usually look at three. We look at a realistic but conservative, so we're still playing it on the safe side. We look at a worst case scenario, and then we look at a likely scenario, but we're not going to count on that happening. So you want to know in scenario, or the worst case scenario, what would the returns look like then? How safe is my investment going to be if that were to happen? Sources and use of capital. So if I'm raising $3 million and it comes from a pool of 10 or 20 people, whatever it is, I want to be able to tell them in detail, this is what we're doing with it. This is why we need it. so that you understand the sources and uses. What's going to reserves? What's going to deferred maintenance? What do we need to repair? Things like that. And finally, the plan for risk mitigation, which I kind of touched on earlier. All right, know and trust your operators. Due diligence. I'm telling you, this is not something, so we don't do, and I always use this analogy, everyone that I work with, none of us tonight, or our families, no one's hungry, everyone's taken care of, we're doing fine. We don't need to do another deal. Now, we're passionate about this, we're impact investors, we like doing it, okay? But what I'm getting at is we're not going to jump into something just to do a deal. So when we do our due diligence, we leave no stone unturned. We're going to look at everything. And sometimes that means getting in a contract, putting in earnest money, and saying, you know what, it just doesn't make sense for us, and we have to back out. And here's reason X, Y, Z. So again, we're not just going to do a deal to do a deal. It's got to make sense. It's got to be solid and consistent. A constructed, solid business plan. This is, again, something that they should share with you in a packet. Maybe they're going to have an investor call or be willing to meet with you one-on-one and go through things. But you want to see a solid business plan. The intent to execute. So this is something that we always plan on doing. As like I tell you, if we underwrite it with three scenarios, we're looking at the middle as a relatively conservative but likely scenario. In the back of our minds, we're really thinking we are underselling and we're going to be able to over-deliver. We would rather do that than have to come back to you and say, the returns aren't where we thought because of X, Y, Z. We want to have thought of all that already in advance, okay? So intent to execute with the ultimate goal to be over-deliver. We already talked about the worst-case scenario and regularly communicate. So people who invest, they have access to me, they have my cell phone, they can email me, they can text me. Same thing with the other members of the team. It's very important that on a monthly basis, maybe switch over to a quarterly basis if it's smooth sailing. Now we communicate, hey, here's what's going on. Here's how the returns are looking. Here's what we have done. Here's what property management. Here's our current occupancy. So we want to communicate with you. And if anything's ever, like something goes wrong with management or a lot of people move out for X, Y, Z reason, we're actually going to increase communication, not back away. We're going to talk to you more and let you know, this is what's happening, we got it, this is the plan, and here's how we're going to mitigate those risks. Operate the business, already talked about this, with a surgical type precision, and have screened staff so that everyone on the team has the same vision in mind. Everyone says, we realize we've got a team of people who believe in us. We have to make this work. We've got people that need a safe, affordable place to live, and we're all on the same page. That's our mission. Let's go get it done. Unique tax benefits. So this is really cool. This is one of the main, well, two of the main differences between just debt and equity. So cost segregation in multifamily. So multifamily provide the opportunity for us to run these cost segregation studies. And what that does is identifies and reclassifies the asset, okay? And it allows us to take, it's like 27 and a half years that the government allows you to depreciate an asset. It allows us to take it and compress it. I think I have the numbers here. And if I don't, I'll tell you what they are. It allows us to take it and compress it to maybe 5, 7, or 10, or 15 years. What I'm saying is we're accelerating our depreciation, which means you're going to be able to put more of the money that you make into your pocket tax-free. Okay? So that's a really cool benefit of being an equity investor versus debt. Oh, here it is right there. All right, so we said that. And again, legally, you're allowed to put more of that money in your pocket. Okay, so self-directed IRA and 401k. There's something like, and I think it actually, where I read, the source I read this from, I think it was like 10 trillion. So I was like, you know what? I'm going to be conservative, knock a trillion off. There's roughly 9 trillion available in 401ks and self-directed IRAs. And this is going untapped. People are just letting the IRA and the 401k do its thing, not even realizing that they could take control of it. So I said it's kind of it's very small what's used. Many of us don't even pay attention to the accounts, but those of us that do look at 401ks and self-directed IRAs realize that these returns are just, they're not really exciting. Maybe I can do better on my own and self-direct. So also they don't know, people don't even know that there's a chance they can use that money and self-direct it into an asset class like this. So the truth is, they've been underperforming for quite some time, but it's still an under-the-radar investment. Why? Custodians focus on CDs. They focus on what brings in money to them, and they're less likely to tell you about what other options even exist. Why? Because they get paid based off of that. So even if it, unfortunately, and I'm not saying bad things about them. Like I said, there's many ways to create wealth. But even when it's better for the client monetarily to get involved in something like this, they will voice their opinion against it. And I have personal experience with that with a close friend who was interested. When we sent out the deal package, she said, I really want my financial advisor to take a look. And it was actually comical, the responses that we received from him, who, by the way, has never invested into real estate. All right, generational wealth and passive cash flow. This is also pretty cool. What I want you to start doing, I think this is what really moved me also from wholesaling, lending money, fixing and flipping into multifamily, is I started thinking about a stream versus a pile. Because even though I was raised by entrepreneurs, and my grandfather was probably the biggest and most successful entrepreneur. He owned marinas and ice houses. I'm from southeast Louisiana. I was born and raised on the Gulf of Mexico, so it's geared toward the fishing industry. Laundromats, he had self-storages. So even though he had, and he had single-family rentals as well, maybe a few duplexes. But anyway, I thought, I need to save a pile of money to retire off of, okay? And that wasn't the right way of thinking. And I'll talk in detail about that. Instead, what I needed to say is take your money, put it, the pile's right there. It's the building. And instead of the pile sitting in the bank depreciating or wherever you're going to put it, this pile is appreciating and it's paying you cash flow. So you just got to kind of flip that switch in your mind. Piles equal problems because savings face inflation. Apartment buildings will and should appreciate, okay? But if I just saved $1 million in the bank, guess what? It's got to fight inflation. It's going to depreciate. If I invested $1 million as an equity owner in a multifamily deal, that's not going to happen. I'm going to be coming out very happy, and I'm going to get paid along the way. So the combined, I kind of already said that. I don't want to read it. Conversely, I said this as well. It's going to build wealth, and it's going to cash flow. A solid average cash on cash. Solid could be whatever solid is for you. If solid return on your money is 4%, 4% or better is solid. If solid is higher, then it's higher. But what it's going to do is provide you with a solid average cash on cash, and the operating team's going to force that appreciation so that you get the large bump on the back end. You're going to get paid quarterly. So if I have time to tell my my 401k story, I never got paid. It sat there, and then when it went down, I was just like, please come back up. But it never paid me quarter, okay, ever. And it definitely, it paid what looked like a profit until, Uncle Sam came with the tax bill, and that's why I was like, we should have buried it in the backyard. I would have felt safer, and we'd have had a better return. Multifamily allows you to pass the wealth to the loved ones. A lot of people invest with trust and LLCs, and all these things can be passed down. And then we'll talk about later in 1031 exchanges, again, another way to defer or defer taxes. Okay, did I have a question? No, sorry. I thought I heard something. All right, so let's switch.
I think you did have a question.
Oh, there is? Yes, sorry.
Hey, can you just, I know you talked about the tax advantages. Can you just highlight that the recapture is going to happen? Just make sure that at the back end that you have enough money to cover the recapture plus profit, just so it's not, it doesn't seem as if it's too good to be true.
Yeah. So I'm not sure if I understand.
So you're going to take a depreciation of 27 and a half years.
Accelerate.
You're going to accelerate it in 5 years. 5 years, if you were to sell that property, you're going to recapture your 27 and a half years of depreciation that you took in 5 years.
Right.
You have to pay that to the IRS. But in addition to that, it's doable.
Yeah.
If you can depreciate it, take that. But
Sure.
you want to make sure the numbers make sense. If you are going to do that, that's part of the strategy.
Yeah.
Then,
Go ahead.
so then you can do that, and then also make money because it's going to make you stupid money when you sell it. Because you did this value add.
Yeah.
The reason you're going to take the reason you're going to take that 27 and a half years depreciation in 5 years is because you also did a whole bunch of value add to it, the property, a lot of operating expenses as well. So and then when you sell it, you'll sell it for double. And who cares if you have to pay a couple mil or a mil or
Yeah.
or whatever.
Yeah, and then that's when the 1031 can come into play.
Sure.
So we can take and find an equal or a like or bigger opportunity and roll it over and enjoy the tax free.
We
What is
better
it?
do a 1031.
About 5 minutes. Running out of time.
Oh, okay.
Or,
Sure.
Okay. So I tell you what, I'll answer the questions. It looks like I got like 4 minutes left. So
We're
let's-
not going to yank you off the stage.
All right, he's gonna pull me with a hook. All right, I'm gonna do these quick. I'm gonna show them all and just talk about the ones I want to talk to. So live where you love, invest where it makes sense. Unfortunately, right now I don't even underwrite properties in Colorado. Like I say, we're looking at Midwest and the South. If you have an experienced team of operators, you should not be geographically constrained. It doesn't matter. You're going to have the property manager, the quarterback, they're going to be local. You're going to have some of the operators traveling out to the site to shake hands, to check everything every 6 to 8 weeks maybe, so you don't have to be geographically constrained. Let's just jump down to criteria. So question is, where does it make sense? Criteria: high yield secondary markets are a good place to look. So if I was looking in Denver, maybe I do want to look at something like Littleton or Lakewood or Aurora, something outside of Denver, but it's still considered that secondary market. And then criteria 2, the market cycle. Where are they? Recovery and expansion are great. We are right now in hyper supply here well, not here in Denver, but I mean the springs are, I'm not gonna lie, the springs is hot. I can't underwrite deals here either. They just weren't making sense for syndication and recession. So you want to try to avoid those. All right, let's move on. The wealthy. Why the wealthy? We're getting close to the end here anyway. Why the wealthy? This was a great article that I read, and I just kind of took some bullet points. Some of the things I've already touched on. They like the control it provides. That's one of the different things. I invest into the stock market. I have zero control over my investment. At least with this, when you put your money, you're placing your bet on the team that you selected and the team that you believe in that's going to be able to get the job done. They have control, a lot of control over what happens with the asset. Leverage of debt, it's like we would never go and buy an apartment cash, even if we can pull the cash together and buy it cash. Because why? If I can get an agency to lend me 3 or 5%, fix it for 10 years and amortize it over 30, then that means I only have to come in, or we as a team have to come in with maybe 30%. And our cash on cash really skyrockets when we take advantage of that debt. And unique tax shelters, we just talked about cost segregation in 1031. So when you 1031 is when you sell, not refinance. Because by the way, if you make a profit on a refinance, that's not taxable. You still own it. You're placing new debt, that's profit, okay? But when you sell, there's going to be consequences unless you 1031 exchange into a bigger asset or a like asset. So you're taking that money, putting it into another investment, and you're deferring the tax, okay? The perks of cash flow, let me zoom through these. All right, there we go. They're priceless. Safe, stable, consistent streams of passive income. Experience the appreciation, that bump on the back end. He was just talking about, hey, who cares if we accelerate it and we get all these tax benefits? When we sell it, it's going to be double or whatever, and everybody's going to be happy, especially if we 1031 exchange that. You don't have all the headaches of being a landlord. Your money works for you even while you're sleeping. and you have the unique tax. You can buy back the time, and all of that is priceless. So I'm actually not even gonna go through these. I'm just gonna say, like I said, I have nothing. There's nothing to sell. What I always ask people is, who do you know that we should know? Do you know someone who is having a problem finding a place to put their money? Maybe it's worth them investing time with a phone call. Meet one-on-one if they're local. I'm local too. I mean, I'm in anywhere from south is 12 Load, north is Fort Collins. I can meet one-on-one. I can hop on the phone, and we can talk and establish a relationship, okay? And I always ask, just please make a quality connection between us. So with us, and I will talk about, I didn't talk much, I'm not an SEC attorney, I'm not an accountant, a CPA, or anything like that. But I do know that we use an SEC exemption called a 506B, which means in order for anyone to ever participate into one of our investments, we have to have a substantive pre-existing relationship and understand your investing abilities. Understand your goals and how well you can analyze something before you can make an investment and join us. So we gotta have that. We can, SEC attorneys, I've had 3 of them confirm this with me. This can be done with an investor questionnaire. And basically you're just answering a few questions that allows us to determine whether or not it's something that you would be able to participate in, okay? There's one on my website. It's at the bottom. I think there's one if you text it, you can see what they look like. If you're ever interested or you know someone that might have that, like I call the money problem. And that's it. I rushed to the last one, but I do want to say thank you, and if we ran out of time, we can, before they kick us out, I'm happy to take a few questions, and I do want to thank you for having me here.